Hi, I'm Mark McInerney from Your Financial Life, and this is our Smart Debt series. So there are two types of debt: inefficient or bad debt, and efficient debt, which we would call good debt. So inefficient debt is used to buy goods, services, and assets that won't generate an income. They depreciate in value, or once you buy them, they have no value at all. And because no income is generated, the interest on the debt is not tax deductible, and it needs to be repaid using your own financial resources. So it's a good idea to reduce this kind of debt as soon as possible. A car loan is a classic inefficient debt, as we all know, as soon as you drive the car off the car yard, it drops by 20%. And it never generates any money. In fact, it costs you money. Credit card used for general living expenses is shocking debt. If it's not repaid within the interest-free period, it starts costing you extra money. And this is because of the high interest rates on the debt. It's not tax deductible, and things bought generally have little or no resale value. Home loans are also generally less efficient, since a home does not produce any income, and the interest costs are therefore non-tax deductible. So efficient debt is used to acquire assets that generate tax assessable income and have the potential to grow in value. So as the assets generate an income, the interest costs are tax deductible. The income produced by the asset can also be used to repay that debt. An example of efficient debt is an investment loan where the proceeds are used to purchase shares or property. They may be purchased directly or through a managed fund. The asset that has the potential to appreciate in value and generate an income, and therefore the interest on the loan is tax deductible. So let's have a look at a smart debt strategy, consolidating your debts to save money. Inefficient debt is an obstacle to improving your financial position, and it should be eliminated as quickly as possible. One way to do this is to minimise the amount of interest you're required to pay on your loans, so that more of the loan repayments are reduced to reduce the actual debt. A simple solution is to consolidate all of that inefficient debt into the loan structure that has the lowest interest rate. As a guide, home loans generally offer the cheapest rate. Personal loans for cars and holidays are higher rate, and credit cards are generally the most expensive. And that assumes that you haven't paid it off on a monthly basis. So how does the strategy work? When a home loan is increased, the additional borrowings can be used to pay off all of the other personal loans and credit cards. The number one advantage of this is that the lower interest rates on the home loan will apply to all debts, saving interest on those other debts. And let's assume that the same overall repayments continue to be made, so that inefficient debt can be eliminated more quickly. It's important to find out whether an existing home loan offers the features and flexibility to repay inefficient debt sooner, such as a 100% offset account and the ability to make additional payments. If it doesn't, it could be better to consolidate the debt into a new loan that offers these features. So let's take a look at a working case study. Adrian, age 39, and Bethany, age 37, are married with a young family. Their home is currently worth $450,000, and they have several debts. So they've got their home loan, about $200,000, which they're going to repaying over about 20 years. A personal loan for $25,000 and $5,000 in credit card debt. You'll see that the interest rate on the home loan is the lowest, about 7.5%, and the personal loan and credit cards debt is much higher. So they've got $230,000 in outstanding debt, and their current payments in total is over $2,200. So to minimise their total interest bill and make their finances more manageable, they approach their lender about consolidating their debts. So they want to increase their loan from $200,000 to $230,000 to consolidate the personal loan and credit cards. So assuming their lender approves the application, their balance on their home loan increases to $230,000 and will be subject to their 7.5% interest rate in this example. So the result in a new minimum monthly payment of about $1,853 and cash flow savings of $380 in the first month alone. So let's look at what the results are. We've consolidated the separate loans of $230,000 into one loan. We're assuming in both options that the repayment of the $2,233 per month are continued to be made for the life of the home loan. With the separate loans, once the personal loan is repaid, these payments are redirected to the home loan. The key to this strategy is to use the cash flow saving to pay off extra capital each month. For this reason, Adrian and Bethany decide to maintain the existing $2,233 per month payment on their consolidated loan, not just for the 5 years that the personal loan would have lasted for, but for the entire term of the consolidated loan. This enables them to pay off the consolidated loan earlier and save just over $13,100 in interest. With this strategy, it's important that the monthly cash flow savings are used to pay off capital. It can be tempting to keep the savings for private expenditure, but this will negate the advantages created by the strategy. For example, if Adrian and Bethany were to consolidate their debts but only make the minimum monthly repayments of $1,853, they would take 20 years to repay the loan, and their total interest repayments would be $214,689 over the term of that loan. So if your circumstances permit, this could be a strategy that will help you greatly reduce your interest payments and debt quicker. But always remember, before you take any financial action, seek the advice of a professional financial planner and budgeting consultant, and preferably someone who specializes in debt management.